Did you know that price-to-earnings ratio and earnings yield are just two sides of the same coin? Let's break it down. The PE ratio measures how much investors are willing to pay for $1 of a company's earnings. Let's look at an example. If a stock costs $100 and its earnings per share or EPS is $5, we divide $100 by $5 to get a PE ratio of 20. Earnings yield flips the PE ratio on its head. It shows how much earnings you're getting for every $1 invested. Using the same example, if the stock's EPS is $5 and the price is $100, we divide $5 by $100 to get an earnings yield of 5%. Now let's simplify earnings yield further with a lemonade stand. Imagine you invest $100 in the stand, and after a year, it earns $10 in profit. We divide $10 by $100, giving us an earnings yield of 10%. That means you earned 10% of your investment in 1 year. Here's the key. PE ratio and earnings yield are inversely related. A PE of 20 gives an earnings yield of 5%, 1 divided by 20. A PE of 10 gives an earnings yield of 10%. The lower the PE, the higher the earnings yield. Let's compare two real stocks, Tesla and Dick's Sporting Goods. Tesla has a PE ratio of 108, while Dick's Sporting Goods has a PE ratio of 16. What does this mean for investors? Tesla's high PE ratio gives it an earnings yield of just 0.93%. Meanwhile, Dick's Sporting Goods, with a lower PE ratio of 16, has an earnings yield of 6.25%. So, for every $1 invested in Tesla, you're getting about 0.93 cents of earnings compared to 6.25 cents for Dick's. Why the giant difference? Investors expect Tesla's growth to be much higher, while Dick's reflects more modest growth, or perhaps undervaluation. Earnings yield helps you decide if a stock is worth your money compared to other investments, like bonds or real estate. A higher earnings yield often means better returns for your money, but don't forget to consider growth potential and risk. Now you know how PE ratio and earnings yield work together. Like this video, comment with your favorite metric, and subscribe for more investing insights.